Hello and welcome to the Workplace Benefits channel. In this video I'm going to talk about whether an employer should use a universal life or a whole life plan to fund the employee-owned life insurance part of a life insurance suite of products that they offer the employees. My name is Michael. I am the president of GLG America, and my role is just trying to make sure that if the worst happened to an employee or one of their family members and they died today, that you've done everything you can to help them prepare for it. Okay, today's topic I'm going to talk about whether you should use a whole life insurance program or a universal life insurance program to fund that portion of the employer-sponsored programs that the employee pays for on their own and can always hang on to regardless of whether they work for the employer or not. Now, in the last video I talked about that, and I put a link in the corner there, so if you want to follow that link and watch that video, that's a link to it. Now, before I begin here and tell you what I recommend, I just want to kind of go over some terminology because sometimes people think they have the terms correct and they don't. So I might restate some stuff that you already know, but I just want to make sure that we're on the same page kind of going forward through the rest of the video here. Now, when they started life insurance, they created two types of life insurance. The first was called term insurance that lasted for a certain term or time period. And then if the person didn't die during the time period, then they didn't have that coverage anymore. And so a good example of that is if your basic group term life insurance, its term is while somebody works at the company and then it expires and you don't have it anymore. So if you die outside of the term, it's no good. Another example would be like individual term insurance. So if somebody buys like a 20-year level term, it's good for 20 years and then it expires and then you don't have it anymore. And most people outlive term insurance, and sometimes people want something that will always pay. So what insurance companies did is they created these programs called whole life insurance, and whole life insurance policies did what they say is they last their whole life, their entire life, and they're always going to pay. Now, when they first were created, the insurance company took all the risk. So they guaranteed the premium, they guaranteed the face amount, they guaranteed the cash value. And so it's a unilateral contract. So if the employee paid their premium, the insurance company had to pay all the values and everything they said they would, regardless of what had happened to interest rates or the economy. As long as the employee followed through on their part, the insurance company couldn't get out of paying what they said they would contractually because they guaranteed it. Now, in the late 70s and early 80s, interest rates were really high, double digits. I remember CD rates were double digits. People could put their money in the bank and get a lot higher interest rate than they could in these old whole life insurance policies that seemed outdated, that had these guarantees and were very conservative. And so insurance companies were challenged to offer a product that allowed those cash values in those policies to be tied to short-term interest rates to give people the opportunity to earn a higher interest rate than they would have. And that's when universal life was created. And so when it first started, it was pretty good because interest rates were really high and people did pretty good. But then, as you know, like right now, we're in a very low interest rate environment and interest rates fell. And then a lot of these policies had problems because they were underfunded. And so employees or people had to come up with extra money to pay premiums. And if they didn't, then the policies just expired. In fact, my mom had a policy that when she turned 65 years old, she didn't even know there was going to be a test in there that just checked to see if there was enough value in there to guarantee that if she paid the same premium she had been paying, that it would last for life. And of course, she didn't pass that test. The values in the policy wouldn't support it, and so they had to increase her premium and they tripled it, and then she couldn't keep it anymore. So a policy she thought she was going to have for her entire life, just didn't pan out that way. So what insurance companies do, you have these whole life policies and they, let's say, it's $50 a month for a policy that pays $50,000 death benefit. And over here, a universal life policy, maybe you can pay $35 for a $100,000 benefit. Just kind of using an extreme example there. If you're a person sitting at a table going, okay, which one should I buy here? It seems like the one for $35 that gives you twice as much death benefit is a better deal. And so it is, as long as you understand how the contract works. So what happened is the reason these two policies are different is because the insurance company transferred the risk from the insurance company that unilaterally they would always do what they said they would, the interest rate risk, over to the policyholder, and they would assume the risk. And that's why they gave them a lower premium and higher face amount, because they are taking that risk. Now, as long as you understand that risk, which most employees don't, and you look at your policy every year, make sure it's properly funded, and you keep on top of it every year, then you're going to be fine. Because if you need to put extra money in there like in year 3 and you're paying attention to your statement, you would know you could do that. But most people don't do that. Most people get their statements, and then, like my mom, you find out years later that, hey, you're underfunded, and then your policy is not going to last. So you don't want employees coming to you going, hey, you know what, I got this notice that says I don't have enough money in my policy, and because of that I got to pay more money in order to keep it. You want your employees to have a policy they can always keep and never have any problems with from a premium standpoint. And it's less likely to happen on a whole life policy than it is on a universal life policy, because they've guaranteed all of this stuff over here and not on the universal life policy. Now, I'm not saying that universal life doesn't have some inherent guarantees, but it's possible that those policies can be underfunded. And that's a risk that you want to make sure that you avoid as an employer, putting an employee in that situation. And so I always recommend that people use a whole life insurance policy to fund that part of the employer-sponsored program. And here's the main reason why. If the insurance company will take the risk, like on the $50 a month for $50,000, but they won't for the $35 a month for the $100,000 in that extreme example, and they know what they're doing, and they have all the information, and they're the experts on risk, then how can you justify accepting that risk as a policyholder who has no experience in risk and what's going to happen in the future? So if the insurance company won't take that risk, then I don't think the policyholder should either. And so that's why I wholeheartedly recommend the whole life insurance option over the universal life option. Even though over here it looks like it's such a much greater deal, well, it might not be as good as it seems. So I hope that helps you understand why I recommend whole life over the universal life. And if you have any questions, be sure and put them in the comments. Be happy to help you with that. If you're new to my channel, subscribe to my channel and hit the like button. That way it's easier for people to find when they're looking for these kinds of videos. And again, my name's Michael. I'm with GLG America, and I'm just trying to do the best I can to make sure that if the worst happens and an employee or one of their family members dies today, that you've done everything you can to help them prepare for it.